So I'm sure you can hear me clearly and you can see my screen.
You're welcome, sir. Good evening, sir. We can hear you. We can see your
Yes,
screen.
sir, we can.
Okay, that's good. Okay, so today or tonight, we are going to round up with IFRS 2 on share-based payments. So last week, we looked at the introduction to share-based payment, and I can remember clearly that we finished up with equity settled share-based payments. Today now, we are going to finish up with the remaining part of share-based payment. And we told you last week that share-based payment is where an entity receives goods or services, and the consideration that is paid for those goods or services are the equity instruments of the entity, or the entity pays cash, but the value of the cash is now based on the share price of the entity. The logic here is this, that the conventional way we consummate transaction is now being upgraded, whereby an entity is attaching transactions with their shares. And from that explanation, I told you that the origination of this standard came about when all these blue chip companies were coming up, that they were giving their employees shares in return for long-term service, that if they stay with them for many years, they would be rewarded with shares. So in that scenario, we're able to understand that what these companies were doing actually was that they were giving their staff a share option, because a share option is just a right that a party has to buy the shares of another entity in the future. That is a share option. It's different from shares. When they issue shares to you, you outrightly become a shareholder. You outrightly become a shareholder. Now that we have this standard, the first thing we looked at were the types we are going to cover. We said there is the equity settled share-based payment, there is the cash settled share-based payment, and there is the one where the supplier or the counterparty has the choice of settlement. The first one, which is the equity settled share-based payment, we mentioned that one, the entity receives goods or services, and the consideration they pay for those goods or services is their equity instrument. And I'm sure you will remember that when I mentioned equity instrument, I said these are shares and share option. Shares that makes the counterparty or the receiver of those shares a shareholder immediately, or share option that makes the counterparty or gives the counterparty a right to buy the shares of the entity at a specified price at a specified future date. Then for cash settle, the entity gives cash in return for the goods they have received. And this cash value will be based on the share price of the entity. So something about cash settled is that is something is a cash they will pay in the future. It's not like they are paying it now. They are paying it in the future. They will ultimately pay cash, but the value is based on the share price. So they can say that we'll pay you cash equivalent to 5,000 shares, like that, something like that. So, but ultimately, it's cash they will pay. And the third one, where the supplier has a choice of settlements, So the supplier or the counterparty can decide that, okay, I want cash or I want shares. So he will decide what he wants. So that one is equity or cash. And the ultimate decision maker in that third scenario is the counterparty or the seller. Okay, the person that is selling the goods to the entity is the one that will decide. So even the entity itself does not know what the person would choose. We'll look at it today. So now, so we started with the recognition last week. I told you that share-based payment transactions generally are recognized when the goods or services are received. And for equity settled, you simply debit expenses or assets depending on what the entity is receiving. If they are receiving services, you ultimately are going to record expense. If they are receiving goods, that also will be purchases, which is expense. But if what they have received is like an asset, if they have bought PPE, for example, now, then in that case, we will be debiting asset. And the credit side is now equity reserve or option reserve, right? It should be a reserve because what they want to do is to give equity instrument. However, I explained to you that if what the entity is giving is shares, so they won't credit reserve, that they will credit share capital immediately. But you might not find that kind of situation in the exam because it's quite straightforward, at least as a singular question. So the situation we'll find is where what the entity is paying or giving is a share option. And in that case, what you're going to credit is a share option reserve or an equity reserve. On the flip side is cash settled. For cash settled, what the entity is paying is cash, or what it will pay is cash. So, of course, you debit expense or assets, and the corresponding credit is going to be a liability for cash settled. That was the recognition of share-based payment transactions. Now, for the measurement, we said that the challenge here is we started with equity settled. We started with equity settled last week. Then the first hurdle we crossed is that there are two varying or distinct elements here. The first element is that the entity is receiving goods that has its own value, and in return, the entity is paying with its equity instrument that also has its own value. So whose value are we going to rely on? The standard said that when the transaction is with a supplier, that equity settled share-based payment should be measured at the fair value of the goods or services that is received. Why? Because when a supplier supplies good, he supplies it and accompanies it with his own invoice. So the value of the goods can be easily determinable. And that is why the standard said that when it's a transaction with a supplier, simply debit the goods or services, that is, accept or expense with the value of the goods, and you credit the equity reserve with the value of the goods. And we looked at an example last week. However, if the transaction is with an employee, it is difficult for you to know the value of the services rendered by an employee because ordinarily the employee will get monthly salary. And this share-based payment or equity settled is just part of the employee's remuneration package. It is just part of it. So ultimately, we cannot determine the value of that services. So for that case, we have to use the value of what the entity is giving, which is the value of the equity instrument. So when you have transactions with employees, the equity settled share-based payment is going to be measured at the fair value of the equity instruments granted. We now went further that for equity settled, this valuation must be done at at the grant date. So you have to use the fair value of the share option at the grant date to measure this equity settled share-based payment. Finally, on measurement, I told you that when services are rendered, is either those services are rendered at a point in time or those services are rendered over time. Those that render services at a point in time, those ones are usually suppliers. Suppliers render services at a point in time. They'll just come deliver goods and it ends there. In those cases, you will not find the entity or the buyer issuing share option. No, because share option is something that would crystallize or vest in the future. Whoever is selling goods wants a value now. So when it is at a point in time, the consideration is always going to be in shares, something that they can have value for immediately. So for services at a point in time, when you want to measure that, it's quite straightforward because when it is shares, the entity is issuing. It's like a singular transaction and it ends there. You debit asset or expense based on what you are receiving, and you credit your share capital and your share premium. So if it is service received from a supplier, that will be measured at the fair value of the goods or services received. What you will find in your exam is where the services are rendered over time. And this is typical with employees because employee service are received by an entity over time into the foreseeable future. And in entities or employers, they give employees share option to encourage them to even stay longer, also that they won't just leave untimely. So they give them share option. And that is what you will find in your exam, where employers give their employees share options. And because these services are rendered or received by the entity over time, hence, the equity settled share-based payments must also be recognized over time. Over time. So we would need to always identify, firstly, when is the grant date? When did we promise our employee that we're going to give them share option? We also need to determine the vesting date, when that share option will actually become shares. The intervening periods is the vesting period, and that share-based payment must be recognized over that period. And finally, last week, I told you that in each year, in the first year of that equity settled transaction, at the end of each reporting period, at the end of the first year, for equity settled, I told you that we have to determine the best estimate of the number of employees that will vest. The best estimate of the number of employees that will vest. That we are going to use to measure the value of this equity settled in the first year, which we are going to then prorate based on the vesting period. The same thing we will do in the second year. We will also estimate the number of employees that will vest. And why are we making an estimate of the number of employees that will vest? Remember, this share option will only become shares in the hands of the employees that meet the vesting condition. Because that will happen in the future. And we can't know with certainty what will happen in the future. So we need to estimate and just assume the number of people that will actually vest in the future, so that what we are recognizing today will not be so far from the future. Whenever you are required to make estimates in the exam, be sure that the examiner will give you a guide, or the examiner will give you the specific estimate. And don't forget, finally, that this share option or this equity settled share-based payments must always be measured at the fair value of the share options at the grant date. And the grant date is the date the entity granted the share option to the employee. The entity signed an agreement that, okay, I'm giving you a share option. They will always give you that in the exam, in the question, in the exam too. So after those explanations, we looked at three questions. I remember vividly last week, we looked at three questions. Question 4.6, question 4.7, and question 4.8. And I can also remember that after solving those three questions, I gave you assignments, which none of you did. I'm sure that is not something you want to continue with. You have to do your assignments to test your knowledge and to help yourself. And by my calculation, today is our 5th class by my calculation. That means after today's class, we have just 12 classes to go. Just 12 classes. And we have a lot to cover. We don't have time. You don't have time. Nobody has time. So you don't want to be deferring reading. That will not, you'll be doing a disservice to yourself. I advise you to go back and do your assignment. Okay, so today, we are going to round up first on equity settled share-based payment. And we are going to round it up with something we call modification, cancellation, and reissuance. But the focus is going to be on modification and cancellation. The first thing is modification. And so listen up. So, an equity settled share-based payment could be modified. And what would trigger this modification? What usually triggers modification is where the equity settled share-based payment becomes unattractive. What do I mean by unattractive? The first thing is this: what even makes this share-based payment attractive? Why would anybody be excited, specifically employees, about not giving me money now and saying that you want to give me certain shares in the future? What will make anybody excited about that? You see, what makes them excited is the value. So, you see, at the grant date, at the date of the agreement, there are always three values present. The first one is the fair value of the share option, which is what we use in our books to record this transaction. The second one is the share price of the company, the share price of the company. So let's hypothetically say the share price of the company is 5 naira today, because we will know that. And the third thing is that they would agree on the date, on the grant date, is what we call exercise price. Exercise price. You see this exercise price, it represents how much the employee will eventually buy these shares. Yes, they actually buy it. They buy those shares at the vesting date in the future. They buy them. So what makes it attractive is that if the share price today is 5 naira, they will set that exercise price to be like 2 naira, to be like 2 naira. So anybody that looks at it and say that, they are giving me shares that I will buy, let's say the vesting period is 3 years, that I will buy in the next 3 years for 2 naira. Even today, the share price is 5 naira. And companies that do that are mostly blue chip company that has huge potential to grow. So immediately the person is calculating that in the next 3 years, this share price that is 5 naira might become 10 naira. And whatever the share price becomes, the employee will still buy it at 2 naira. So if that date comes and he buys the shares, he drops 2 naira for every share option they give him, 2 naira, they award him shares. That means if he sells those shares that same day, he's going to make huge profit. Some can even become a billionaire with that. I mean, it has happened practically. So don't lose sight of what I'm trying to tell you is what makes this equity settled attractive. That is what makes it attractive, is what the employee are going to pay for it is relatively small compared to the value of the shares. However, the future is inherently uncertain. Things can change. Look at it. The share price today was 5 naira. After 2 years, maybe there was financial crisis. Unexpected events happened that the shares was now declining as against increasing. It was declining. It was declining. Maybe after a year, the shares became 3 naira. What happens is that this share option, this arrangement, as it were, is becoming unattractive. So what entities do when that situation arises is to reprice. They will reprice the share option package. They will reprice it immediately. And repricing it means that they will also reduce the exercise price. They will reduce the exercise price so that it's continually is attractive. So if the margin between the share price and the exercise price at the grant date was 3 naira, for example, now, the difference, if the share price start falling, they will also reduce the exercise price also so that the margin would maintain that 3 naira. So reducing the exercise price is what we mean by repricing. And that is what we mean by making the equity share option package attractive. That is not where we are going. That's not where we are going. That is just to make you understand what usually results in modification. Where we are going is this. You see, when they reprice, what they have done in essence is that they have improved the value of that equity settled share-based payment. They have improved the value. And don't forget, the value of an equity settled share-based payment is based on the fair value of the share option at the grant date. At the grant date. So when they reprice, that value becomes enhanced. That value becomes increased. So whenever they tell you that there is a repricing or there is a reduction in the exercise price, the examiner will also tell you that this has resulted in an increase in the fair value of the share option of the entity. That increase is the focus here today. Because how do you account for this entire arrangement? The first thing is what I taught you last week. That one will stand. You will still continue to do that, what I taught you last week. The only additional thing we're adding today is the increase in the fair value of the share option. Look at it here. The increase in the fair value of the package that is caused by repricing. So that also, it now becomes an additional cost to the company because the valuation of the share option package has been increased because of the repricing. Now, let's look at this question so that you would see what I'm saying practically. This question states that Delta prepares financial statements to 31st December each year. And I said on 1st January 2002, that Delta granted 500 share option each to 10 senior executives. That means that this 1st January 2002 is the grant date. Now, of course, there are 10 employees. Okay. Then I said the option vests on 31st December 2005. So it is 2005 that the employees can now sell or can now buy those shares in 2005. And the only people that can buy it, look at what they said. They said, provided that the relevant executive remain in employment and provide services until that date. So the only people that will vest are those that meet this vesting condition, which is that they must be there till 31st December 2005. It now said, on 4th January 2002, Delta estimated that all 10 executives would remain in employment for the 4-year period. So if you count from 02 to 04, 2, 3, 4, 5, that is 4 years period. Don't interpret that as 3 years. Don't go and do 5 minus 2. That will be wrong. 2 inclusive, 5 inclusive. So 2, 3, 4, 5, 4 years. So they are giving us an estimate on 1st January that all of them will remain and they will be entitled to the share option. See, one is that this sentence, all things being equal, should be ignored because the estimates we need would be made at the end of each year, not at the beginning of the year, at the end of each year. So let me see if they will give me estimate at the end of the year. So they said this estimate was confirmed on 31st December 2002. Now they have confirmed this estimate. So good, fine. So that means we are saying that at 31st December 2002, he said that 10 executives would remain. That 10 executives. So will remain in employment for the 4-year period. That means they're not going. Good. So we are saying that at the first year, which is 31st December 2002, we are estimating that 10 people will vest at 31st December 2005. And the same thing applies to 31st December 2003 too, which is the second year. So the same estimate is made that nobody is going. That as at the end of 2002, we are estimating that 10 will vest at the vesting date. Vesting date is what we are estimating for, not the current year. So they now went ahead and gave me the fair value of the option on 1st January 2002 was 2.2, which is the fair value of this share option at the grant date, which is what I will use to measure this share option. And I went ahead in the second paragraph. Okay, ordinarily in this first paragraph, this will have been the end of the question. I'm sure that this second paragraph now will talk about that repricing. So they now said during the early months of 2003, the share price of Delta fell significantly, and on 30th June 2003, Delta repriced the option package by reducing the exercise price from 4 naira to 3.4 naira. That is what we need. We don't even need this one. What we need is that they said this cost the fair value of the option at 30th June 2003 to increase by 60 kobo per option. This is what we need because the way we value this equity settled in our books is using the fair value of the option at the grant date of 2 naira 20 kobo. Now they are saying as a result of the repricing, which resulted in reducing the exercise price by 60 kobo, that has also caused an increase in the fair value of that option at this date by 60 kobo. Now, you know, I said, how will this be accounted for? See, it's quite straightforward, right? So if you have revised your notes, you will know that at 31st December 2002, which is the end of the 4 year, the value of this share option is going to be 500. Let me start with the number of employees that will vest. Since they have estimated that the entire 10 will remain in employment at the vesting date, so it's going to be 10. This 10 multiplied by 500 multiplied by 2. That gives me the value at the end of that year. So now we are talking about 4 years now. So I need to recognize year 1. So I'll simply prorate it by multiplying it by 1/4. When you do that, that's what I've explained here. That will give you 2,750. 2,750. In year two, and remember, this I taught you last week. If you have done your assignments, this will be a walkover for you. Remember, this 2,750, you simply debit staff costs and you credit equity reserve with that amount. In year 2, it's the same because nothing changed. They said in 31st December 2003, all the 10, you are still estimating that they will be there at the vesting date. So it's still the same logic. It's still the 10 times 500 times 2.2. But in year 2, you know that it will be times 2/4. It should be cumulative. If you do times 2/4, what you will get will be, if you press your calculator, 11 divided by 2, that's 5,500. I told you that 5,500 is cumulative, year 1 and year 2. And that will be the balance in the equity reserve. What goes to your staff cost will be that 5,500 in equity reserve at the end of year 2 minus the opening, which is what is in your equity reserve in year 1, which is 2,750. If you get the difference, it gives you 2,750. So by implication, for the entire 4 years, since nothing changes, what goes to your P&L every year is 2,750. So the equity reserve will just be increasing by that 2,750 until at the end of the 4 year, it's going to be 11,000. So that you will do. But in this question now, we're only doing 2002 and 2003 because that is the only estimates they give us. So in 2002 now, we will get 2,750. And that is it for 2002. Now, in 2003, we will still get 2,750 as what goes to staff cost because it's the same thing. The estimate is the same. No one is going to go at vesting date. However, in addition to that, there was a repricing on this date, and the fair value of the share option has increased by 60 kobo. So, two things now. In addition to doing this same thing in year 2, valuing at 2.2, so you will be wrong. If you go and do 2.8, you will be wrong. Because whatever you do here in year 2, you know that you'll be multiplying this by 2/4. By 2/4. You are saying you're in the second year. But you see, this repricing, this 60 kobo increase in fair value now, it happened in 30th of June 2003. So this increase, whatever value the increase gives rise to, which is this, which is the 10 employees times 500 multiplied by the increase, it gives me 3,000. This 3,000 is an additional cost that would be recognized over a period from 1st of July 2003 This increase started from 30th June 2003. So it will recognize from 1st of July 2003 till the vesting dates, which is 31st December 2005. And that's a period of 30 months or 2.5 years. So this 3,000 is going to be spread over 30 months. So it will not make sense if you have added it together with this 11,000. Mathematically, that will be wrong. That's why we have to separate them. So in year 2, you will get your 2,750 in staff cost and your equity reserve 2 increases by 2,750. But the additional costs, but the increase in the fair value of the share option, you do that separately. And this 3,000 in 2003, we are out of this 30 months in 2003. Knowing fully well that it's starting from July 2003 up to 31st December 2003, we are going to recognize as at 31st December 2003, we are going to recognize only for 6 months. So this 3,000 will prorate it by 6/30. This 6 representing the fact that for this year, this increase started from 1st of July and the end of the year is 31st December. That's 6 months. And this 3,000 is going to be recognized over 30 months. So it's going to be 6/30 multiplied by 3,000. And that will give me 6,000. So therefore, as at the end of 2003, what we'll recognize in our staff costs will be 3,350, being the normal one that is valued at 2.2, that will give rise to 2,750, and the increase that we got here at 600 for the second year. Okay, so that is it. Now, I want to try you. I want to see whether you even understand anything I'm saying here. So let me pause a bit. And so they didn't give us estimate for 2004. So let me give you. So let's say they say that all the 10 will still vest at the vesting date at the end of 2004. So at the end of 2004, they estimate that all the 10 employees will vest at 31st December 2005. So I want you to tell me, considering this repricing, how much will be recognized as employment expense in 2004?
So
Yeah,
3.950.
3,950. How did you get that?
With the question, we're already for each year we're supposed to get 2,750.
Okay.
So plus the additional. So this time we would be having, sorry, let me get back to the question. We'll be having the 3,000, so times 12 divided by 30.
Okay. Wow, that's so. What did you get? What did you say was your final answer?
For 20, it will be 3.9, sorry, 3,950. Yes.
Okay, that's fantastic. That's correct. Oh, wow. That's good. Yeah. I hope every other person got the same thing. That's good. That's good. So is your name Elofu, right?
Yes, sir.
Okay, nice one. Okay, so if you don't understand that, let us know. Because if you understand that, that means you understand everything I've been saying, which is good.
So I don't understand it.
Okay. So, let me get you now. Is it the way which one is it you don't understand now? Is it
I think
oh yeah, go
I
ahead.
think the confusing thing is the chair price rebranding, right? I don't really understand how the calculation works.
I didn't say much about the calculation because I didn't want you to focus on that because they will always tell you in the exam. So don't focus on that if that's where the confusion is coming from. So, I mean, they have already told us that there was an increase in the share price by 60 kobo. So I don't think you should bother yourself about how they got 60 kobo. They have told me there's an increase by 60 kobo. And so we are saying that the new thing here is what we have been doing before, what we did last week, that will not change. So the additional thing we're just doing is that, okay, this increase, we are treating it as a separate item. We would calculate it separately because the periods does not coincide. So we have to do it separately because of the proration majorly. So which was what we did. So for the first year, the 2,750 that we got, I want to believe you understand how to get this. And the increase, this 3,000, this increase is from July to December. So this 3,000 is going to be recognized over those periods. So in the first year where the repricing occurred, so this 31st December as at 31st December 2003, so that's 6 months from the date of the increase, 6 months. So that was how we prorated this by 6/30, which gave us 600 naira. So what we're recognizing in the first year is 2,750 plus 600 naira. So it's going to be 3,350. And of course, our equity reserve will have increased by the same amount. So I now asked, what happens in the next year? So in the next year, I've already told you this one will not change because the variables did not change. So it's still going to be 2,750 that will be recognized in 2004. However, for this increase, now in 2004 is a 12-month period. It's a 12-month period. So that will be 3,000 times 12/30. And Elofu got 1,002. And it's logical because when half a year is 600, so which is for 2002, so 2004, that is full year. That should be 1,2. So 1,2 plus 2,750 will give you 3,950 for 2004. So, I mean, just focus on the core things and I'm sure you will get it. You would get it. Prosper, did I even answer your question?
Yes, sir, you did, but I still have more questions to ask.
Okay, please do ask.
So from the question, right? I don't
Okay.
know, during your explanation, you said when the company's share price reduces, right? Then the size price for the share option will also reduce. But in this case, their price increased. I was expecting an increase on the share options price instead of a decrease, right? But then they said the exercise price was reduced from 4 naira to 3.40 kobo.
So what were you expecting?
So I was expecting an increase since the company's share price increased.
So when the company share price increase, what did I say will happen to the share price? To reduce now. They will reduce it to make it attractive, which is exactly what happened. So and I said that they will tell you that the fair value of the share options has increased. And again, don't go back to trying to decipher why. That is not the main thing here. That's not the main thing at all, right? So everything here is in order, is how I've said it. The main thing is not even that. What you should focus on is what happens to, and it's always going to be the same thing. The fair value of the share option will increase every time. So, well, that was why I gave you like a story behind it. That okay, when share price fall to make it attractive, they will reduce the share price too. They will reduce the exercise price, which is what is here. They say they reduce the exercise price because the share price was falling. So to make it attractive, they reduced it. And I said, that's not what we need. It's important they give us that story, and it's important you also understand that background. But it doesn't affect our calculation. It doesn't affect what we record in the books. What affects what we record in the books is the increase, which is what will happen in all cases. Whatever question they will give you in an exam will not be different from what I'm showing you today. So it will result in an increase in the fair value of the option in all cases. Yeah. And that is the only thing we need there, this 60 kobo. And that is the only thing, as you can see, that we have done as an additional thing. That's it. Okay, any other questions?
So
Okay.
I think I understand Prosper's question. I actually looked at it initially. I get the fact that you're saying we should ignore all the other informations in the middle and just focus on fair price and the increment. But if you look at this question, in the end, the excess price that we're talking about is supposed to be the price that's supposed to buy it at the end of the period, after the vesting period, correct?
Okay.
And I'm asking, the excess price, that's
Yes.
supposed to be the price they're going to get this shares for at
Yes.
the end of the vesting period.
Mm-hmm.
So if it fell, why are we just concerned only with this? Because if we added this increment and the amount for the fair price, that's going to give us 2.80 kobo as
Okay.
against the excise price. So it's just more of understanding why we're focusing on that price rather than the excise price.
I think the question should be, why do you want to focus on the exercise price when I've not even mentioned it before? The only time I've mentioned it today is now. So why do you think that should be the focus? When we have already told you that when you want to measure an equity settled share-based payment, you measure it at the fair value of the option at the grant date. Fair value of the option at the grant date. That is the only relevant measure that the standard has mentioned. And the only time I've mentioned this exercise price, I think I mentioned it in the third question we did that last week. That will only become relevant at the vesting date. If you remember, that will become relevant at the vesting date. If you had revised what we taught you, that's what they will now pay. When you debit bank, you will cancel out the equity reserve, then you credit share capital and credit share premium. But in the intervening period, when you're measuring the share option itself, you don't need it yet. Okay. So again, that is not relevant now in this, and that is for as far as this modification is concerned, that is not the focus. It's just what explains why this thing has increased, why the share option has increased. It's just to make it attractive, but that's why the exercise price fell. And I've also explained to you that since they have reduced the exercise price, so inherently, looking at it, it has made the option package more attractive. So which is why the fair value of the option package is increasing. Again, going deep into it, why did it increase? That means you're focusing on the wrong thing here. You have a lot to really learn than to be looking for what nobody will ever ask you in the exam. So again, right, if the examiner would tell us that as a result of modification, in fact, in some questions, they won't even go into so much details. They will just tell you that as a result of modification, the fair value of the share option has increased by this amount. So is that increment you need? And please, let's focus on that so that we won't be dwelling on what does not matter. So what I need you to really focus on, if you have understood that, just stick to that, is what we have been doing, what we did last week remains the same, but the additional thing we are doing is the increment. And this increment will be recognized over the remaining period. And that is what we have done. So if you understand that, fine. If you don't understand that, I think if you look at it again, you will get it, because that is the only thing. Except if you choose to be focusing on another thing. But if you focus on the increase in the fair value of the share option, which is what we have been using to value the equity settled share-based payments, you would get what we are saying. So what is key in the second year that I tested you on is just the proration. It's just knowing that in the second year, this 3,000 will not be prorated by 6 months anymore, but now it will be prorated by 12 over 30. However, so I said you were correct, right? Yes, you're actually correct. You're actually correct. Another person can say that, no, that is 3,000 in 2004. Another person can say it's 3,000 times 18 over 30. Just following how we have been doing it before. Because in this one, when we did 1 over 4, in the second year, we'll do 2 over 4. We're accumulating it. So whatever goes to whatever we get, we'll know that, okay, that's the balance in our equity reserve. So you can do this additional one that way also. If you do 3,000 times 18 over 30, you will see that you'll be getting, when I say 18, that means this 6 months in the first year and the 12 months in the second year, you'll be getting 1,800. And that will be the balance. What will go to your equity reserve as balance, which means 600 of last year and of course additional 112 of this year. So what goes to staff cost as additional for that 2004 will just be the 18 minus 600. You're still going to get that 12 that you get. So either ways, we are still saying the same thing. But to be consistent with what we are doing for the normal fair value of the share option at the grant date. So it would be advisable to do that in the second year. Okay, so again, so ICANN has not really tested this modification before, and I don't really see them testing it, because even the little ones they have tested, students still find it challenging. But I just want to teach it because it is just one principle that is necessary there. First, for you, I've explained everything to you. If you watch the video again, if you can't remember what I've said earlier, if you watch, you will hear everything I've said very clearly. Why the logic behind modification, right? But I actually narrowed down to the fact that whatever it is, it will cause an increase in the fair value of the option, because it makes the option more attractive. So the value will be enhanced. So in addition to what we have done in each year, from the date of the increase till the vesting date, you will also recognize the increase over that remaining period. So which is the only additional thing we have done here. So it's a bonus to you, which I think you should get. Then the last thing here is cancellation. Yes, again, this one too is like a bonus, but again, listen to the logic here also, and also so that you can focus on what is key to us here. So for cancellation, what is happening is that an entity can say, okay, I'm not doing again, that I want to cancel this entire thing. That instead of promising that, okay, I will give you shares, why not let me just give you guys money so that whoever wants to leave can leave. So whatever reason the cancellation, whatever the cause of this cancellation, the point here is that the entity says it's not doing again. And logically, let me use this as a scenario now. So look at it now. In this first year now, we have recognized the total value of this share option itself is 11,000. We are saying because the employee has worked in the first year, we recognize just 1/4 of it. So we now recognize 2,750. The other leg goes to reserve. In the second year, the employer says that I'm not doing again. What happens is this. Yes, you are not doing again, but that means that you are ready to pay the entire everything today. You are ready to pay. That means you're ready to pay us everything. So that means that the initial condition attached to most share option is that the employee must work for that number of years. Me, I'm ready to work for that number of years, but the employer says, okay, I want to cancel. No problem. So that means the employer is ready to forfeit that condition. That, okay, don't worry about the condition. I would give you whatever it is that is the balance. So in that second year, what will happen immediately is that, they will have recognized 2,750 in the first year. In the second year, they don't even need to do any calculation. What is happening when they get the number of people that are present today, let's say is this 10 and the value still remains 11,000. That means whatever is remaining out of this 11,000, so 11,000 minus the 270, 750 they have recognized, that will be around 8,250. That 8,250, they will recognize everything immediately this year. They will debit staff cost with 8,250. They will credit equity reserve with 8,250. So that what is in equity reserve becomes 11,000. So now that they have recognized everything, then the entity would then compensate. The entity would compensate the employee by, they will close the equity reserve account and probably they will credit bank because mostly maybe they want to give them money or maybe they want to give them shares immediately. Whatever it is, they will shall give them. They will close everything. So that's how cancellation works. So what I've just explained, if you understand that, then you won't have to cram all the technicalities here, because what I've just told you is that the cancellation should be treated as an acceleration of vesting. So what I've explained that, okay, in the second year, the remaining part of that 11,000 will be recognized immediately. If you want to express that in technical terms, it's saying that, okay, you're accelerating the vesting. So vesting that should happen in 2 years, we are accelerating it. So it's happening in the second year. So any and of course, they would pay compensation. So, and it will be effectively set against the credits to equity already made. So the compensation, we'll just deduct it from the equity, meaning we'll close the equity reserve, close it, and transfer it to wherever, whether they are paying in cash or whether they are giving shares to the employees, whatever it is that the company wants to do. Okay, let's put that in perspective, that cancellation. So we have Epsilon. Epsilon prepares financial statements to 30th June each year. And on 1st July 2002, Epsilon granted 200 options, each to 50 employees. 200 options, each to 50 employees. And they said that the option vests on 30th June 2005, provided the employee remains in employment with Epsilon until that date. So this is how many years vesting period? 3, 4, 5. This 3 years vesting period. 3, 4, 5. Yeah. So they now told us that the fair value of the option on 1st of July 2002 is 2.5. So this is the fair value of the option at the grant date. 2.5. And like I've always said, this is how we measure the share option, using the fair value of the share option at the grant date. And I went ahead and said that at 30th June 2003, it was estimated that 48 employees would remain in employment until 30th June 2005. So they are giving us estimates at the end of the first year. which is June, that only 48 would remain up until 30th June 2005. That's the people that would vest. So that's the estimate we'll use to value our equity settled at June 2003. Okay, so in the next paragraph, they said on 1st January 2004, Epsilon cancelled the option package. He cancelled it. And now said at that date, all 50 employees who were granted the option were still in employment. Epsilon made a compensation payment to the affected employees of 2.70 naira per option, which was the fair value of the option package on 1st January 2004. How will the transaction be accounted for? Okay, so 2 years in consideration here again. It all started from 1st of July 2002, and we have 200 options to 50 employees. And the fair value of the option at the grant date is 2.50 naira. We're now told that at the end of the first year, of course, I told you we make estimates at the end of every year. It was estimated that 48 employees would remain in employment. So we are going to base our valuation on 48, which is why in the year ended 30th June 2003, we will debit employment cost and credit equity with 8,000, being the 48 employees that will vest multiplied by the 200 option multiplied by the fair value of the option at the grant date. That gives me the value over the 3 years. But since I'm recognizing only for 1 year now, I'll prorate it by 1/3, and that gives me 8,000 in year 1, which I would take the first leg to P&L through employment cost, and I will take the second leg to equity. Now, in the second year, which is 30th June 2004, there was a cancellation. There was a cancellation on 1st January 2004, meaning the employer said he's not doing again. That means he's ready to pay whatever is remaining. So the first question is, what is remaining? And they told us that at, where is it? That at the date of cancellation, all of the 50 were even still there. That means the estimate they even made in year 1 said was wrong, that only 48 would vest, right? Surprisingly, all the 50 were even still there. So that means what is remaining is we'll base our valuation on 50 multiplied by 200 option times the fair value of the option at the grant date. That will give me the entire value of that option at the end of 2004. Out of that value, I've recognized 8,000 in year 1. This 8,000. That means the unrecognized amount is 17,000, which I need to recognize everything right away because the employer said he's not doing again. So that means there will be an acceleration of vesting. So that 17,000, take it to employment costs, POL. The other leg goes to equity. So by implication, we will have recorded 8,000 and 17,000 in our equity, right? That's 25,000 in year 1 and in year 2. Now, the employer said that he would compensate the affected employees with 2.70 naira per option. He's going to compensate them with 2.70 naira. So if you value that 2.70 naira, that means the compensation payment is 27,000. Being 50 employees times 200 times 2.70 naira that is paying them 2 naira. That means the value is 27,000. Okay, so this 27,000, we'll use it to cancel out our equity reserve. So we debit our equity. And we're going to credit bank. All right. So that's that. However, you will see that the this compensation payment is higher than what the employee is due to, right? IFRS 2 says that excess, that you don't need to have or make any further adjustment to that. They said is a consequence of IFRS 2. Please don't ask me why. Why did they do that? It's not relevant. Since IFRS 2 have said that is a consequence of IFRS 2, that you should just leave it in that whatever, in that equity, that excess payment that they made. So since that is what the standard said, so we'll follow it through. I mean, for cancellation again, the core thing here, the core thing is that the employer said, I'm not doing it again, which means that the employer is ready to pay everything at that date. So immediately at the date of cancellation, at that year end, when we are recognizing it, we recognize what is remaining, get the entire value today, deduct what you have recognized before, get what is remaining, and put that in your books immediately so that you update your employment cost and your equity. In this case now, it has been updated to 25,000. So the guy said he will pay them 27. And the way we do that is they said they are giving them 270 kobo per option. So 50 times 200 times 270 kobo. So this 27,000, we'll use it to cancel out our equity, and they are paying money. That's why we are crediting bank, since they are paying money. So we credit bank with that. Okay, so that's cancellation. Okay, so note that this, you should note it because ICANN has never asked this area before, but they could ask it. I mean, as a first timer, we never can tell. Okay, so I'm done with equity settled. Now let's take questions from all of us before we move to cash settled. Okay, let me start with Ayola.
Um, so
Okay.
my question is around the equity. So the equity account we are talking about, is it the ordinary share capital account? Because we're also talking about equity reserve. So I just want to be clear on that.
Okay. So equity reserve is just a separate account under equity. You know, when we say equity, equity comprises your ordinary share capital, your share premium, your retained earnings, your revaluation reserve. So with this topic now, we are saying that there is a new reserve called equity reserve. Some people even call it option reserve. Okay, so that is the one we are referring to here, not the ordinary share capital. Not the ordinary share capital.
Okay, clear. Thanks.
Yeah. Okay, so one thing I would need you guys to do is that today, now after this class, I will give you another assignment, further assignments, and just try and do it, because that's the only way you can know whether you have understood these things or not. And I think this thing I'm sending to you already even has the solution. So just try and revise. If you have any challenges, you can let me know outside of the class. Now, so I intentionally took a lot of time explaining this equity settled because I know that it's exactly the same thing with the cash settled. If you understand equity settled, cash settled is just the same thing. So it's really nothing new. It's the same. However, there are two difference. Please pay attention to this. For cash settle, there are two things that we need to take into consideration that makes it different from equity settled in terms of the measurement, right? So number one is this. You see, the fact that for cash settled, what the employer or the buyer is going to pay ultimately is cash. What is going to pay is cash. For that reason, what we are going to credit, we always debit expense or assets for the fact that we are receiving goods, expense or asset. For equity settled, we said credit equity reserve because that's share option. What the company wants to give is a share option. But for cash settled, for the fact that what we are giving is cash, or what we are going to give is cash, because it's not like we are giving it now, we're going to give it in the future, like much later in the future. It's going to be cash. For that reason, what we credit or the other leg of that transaction is going to be a liability. So anytime you have an obligation to pay cash, know that that's a liability. So that's the first thing here that would change for cash settled. So it's going to be a liability I'll be talking about. Unlike equity settled, I was talking about equity reserve. The second thing is this. Because this is a liability, which is an obligation. For that reason, at the end of each year, before the time when we are going to actually settle this liability, at the end of this year, that means the cash settled or the transaction itself or the liability will be valued or measured at the fair value of the share option or of the option or whatever it is we are giving. Is going to be measured at it at the price, at the fair value, at the reporting date, at the year end. Because this is a liability, we will have to measure it at what is happening at that year end. This is different from equity reserve, where we're measuring it at the fair value of the share option at the grant date. This one, that is a liability, it's going to be measured at the fair value of the share option at the reporting dates at the end of each year. And those are the only two differences here. The logic in terms of how you get the amount, in terms of, estimating the number of employees that will vest, everything is the same, just like equity settled. For this cash settled, the difference is that one, the other leg is going to be a liability. And secondly, we're going to be measuring this transaction at the fair value of the share option at the end of each reporting date or at the reporting date. And for cash settled, this one, why we're common with calling the instrument they issue for equity settled share option. This one they call it share appreciation right. And they could call it some other names also. So whatever it is they call it. So you don't really have to cram this one because it's not like the examiner is going to ask you like that. So whatever it is they have actually called it, or whatever it is they are giving, what is important is the substance of the transaction. Understanding that what the employer will give is cash, and this cash is based on the share price of the entity. And in measuring it, you recognize an obligation or a liability, which is going to be measured at the fair value of that share option, or like I told you, share appreciation right at each reporting date. At each reporting date. And that is it. And that is it. So let's look at this comprehensive question to settle that. So in this question, they said on 1st January 2001, an entity grants 100 cash share acquisition rights. Okay. So instead of saying share option, they say acquisition rights. So that's not even the focus. They shall grant, they give them something and it's 100 count, right? And they have 500 employees. And the condition is that the employee will continue to work for the entity until 31st December 2003. So from here now, the grant date is 2001. and the vesting date is 2003. That means that what's the vesting period now? 1, 2, 3. So that's 3 years. That's 3 years. Okay. And I said during 2001, 35 employees leave. The entity estimates that a further 60 will leave during 2002 and 3. Said during 2002, 40 employees leave, and the entity estimates that a further 25 will leave during 2003. And during 2003, 22 employees leave. And after that, at 31st December 2003, 152 employees exercised their share acquisition rights. Okay, good. At least this one, you see that exercise, how to exercise. We have looked at it before too in equity statute, so it's good. So now said another 140 exercise at 2004, and the remaining 113 exercise at 2005. And also the fair value of the SAR for each year in which the liability exists as shown below with their intrinsic value at the date of exercise. So they give me the fair value of each of those options, or in this case, share acquisition rights. And don't forget, based on my explanation, this is what we will use to measure the option at in each year. And they gave me the intrinsic value, which we're going to use as the exercise price. And in this case, 2003, 15, 20, and 25. But I mean, let's get there first. And that's required. Calculate the amount to be recognized in the profit or loss for each of the 5 years ended 31st December 2005. And the liability to be recognized in the statement of financial position at 31st December for each 5 years. Okay, I know that I've sent you this thing before. But I mean, let's use this thing to see if we can understand how to determine the number of employees that will vest, which is the main thing in share-based payments. When you understand that, the other ones are not difficult at all. Okay, so again, this is the grant date. The vesting date is December 2003, 500 employees. Okay, so now, in 2001, they said that 35 employees leave, and the entity estimates that a further 60 will leave during 2002 and 2003. Without checking anywhere, can you tell me, based on this information given in 2001, how many employees, what was the estimate of the number of employees that will vest? Based on this information given, they said 35 employees leave, and the entity estimates that a further 60 will leave in 2003 and 2002 and 2003. Elofu said 405. Ayola said 465. Okay, so I think Elofu understands these things very well. So it's actually 405. So Elofu, I don't know if you can explain that to us. How did you get the 405?
I remember you said the estimates were going to be included. So if the first year, that's 20x1, 35 employees leave, then they're also estimating that 60 would leave. So I added 60 plus 35, then I subtracted it from 500, which gave me 405.
Fantastic, fantastic. So, yeah, thank you. So they said 35 leave, actually leave, because this is the year end. Of course, we can know people that actually leave, but they now estimate that a further 60 will leave in the next year and in the third year during 2002 and 2003. And what we need to know, what we actually are interested in is the estimate of total departure. The estimate of total departure. So the estimate of total departure is the 35 that actually leave and the additional people that will leave. So that's 95. That means what is remaining is going to be 405. Okay, that's good. What about 2002? What about 2002? So, Ayola, so you said the explanation was clear to you. So let's see if you get this one right. They said 40 employees leave, and the entity estimates that a further 25 will leave during 2003. So, how many, what's the estimate of the employees that will vest? You're actually correct, Ayola. So, how did you get it? How did you get it?
So in 20x1, 35 have left. And in 20x2, 40 are leaving, and there's an estimate of 25. So that
Fantastic.
gives a total of 100.
Fantastic. Fantastic. Okay, good. So 400. So how about in 2003? So 2003 should be straightforward because now we would know that's the vesting date. So we'll know everybody that has left. So 35 that left, 40 that left, 22 that left. So by the time you add all of them together, so 75, that's like 99. So total departure 99 out of 500. So we'll be left with 401. Okay. So if you have gotten that, the other thing is just routine. Those other ones are not difficult. So you just have to not lose sight of this other additional information that they actually gave us. Because after 2003 now, people will now start exercising their right. And in this case now, exercising their right means that the company is now actually going to pay them because this is cash settled. The company is going to pay them cash. It's different from equity settled, where it is the employee that will now buy those shares at the exercise price. Okay? Though the money is small, but it's the staff that will pay, it's the company that will receive money. But for this one, the entity is actually paying. So at the end of that same 2003, they will pay 150 people, and they will pay each of them at 15 naira. In the next year, they will pay 140 people. They will pay each of them at 20 naira, the intrinsic value. In 2004, okay, that's 2004, 140. In 2005, they will pay the remaining 113. So let's see how it works. Let me show you the solution. So in 2001, remember, we have 100 share acquisition rights. We have 100 share acquisition rights. 100 multiplied by 500 times minus 95, 405. We all did this together. And this 95, like I've explained to you, is 30 plus the people at the estimate that will leave, making 95. So we have 405, this minus this. Then multiply by the fair value of the rights at the end of the year. I told you that cash settled, you use the fair value of the right or the option or whatever instrument they are issuing out at the end of that year. So they gave us 14.4 here. So you are measuring it at 14.4. So this together gives me the value of the rights for the entire period. So I'm recognizing for year one alone. So I multiply it by 1/3, and that gives me 194,400, which I will take to staff costs. and liability in this case now. And liability in this case now. In year 2, 31st December 2002, 100 share acquisition rights, just like Ayola explained, 35 left in year 1, 40 left in year 2, and they estimated that additional 25 will leave. Okay, so if you do this arithmetic, you come to 400 employees that will vest at the vesting date. You measure it at the fair value of that right at the end of year 2, which is this 15.5 for year 2. So that gives me the value over the 3 years. Since this is year 2, I get the cumulative times 2 over 3. When I get the cumulative, if you press your calculator, it will give you 413,333, which is sitting in the liability. This is the cumulative. So what goes to your liability, or we are saying that, okay, this is a schedule, not debit and credit now, right? So we can say, okay, this is the balance of our liability at the end of year 2. So what goes to P&L is the one that relates to this year. So which is why I showed you as 413,333 minus the opening balance, which is this opening balance in liability at year 1. So that gives me 218,933. This is what goes to P or L. Okay. And that's that for year 2. Now, in year 3, at the end of year 3 now, so this approach I used because I feel that would be easier for you so that you won't be repeating things since they started exercising in year 3. Okay, so I just said, okay, 150 exercised. Each of those 150, we are giving them 100 SAR, and we are going to be giving them at a value of 15 naira, which is the intrinsic value, which is this. That's why they give us for year 3 alone. If you trace it down, you see that it's year 3. So if you do the maths on your calculator, that means the company is going to be paying 225,000. This is what they are going to be paying. And when I say paying, that means their liability will reduce. That's why I debited my liability. And because money is going out from the company in accredited bank, right? So you might not necessarily show this debit, this credit, that. What is important is you understand that when we say exercise in cash settled, it means that the company is going to pay whatever the exercise value you have gotten. So immediately I want to get what is now how much am I owing now? If at the end of year 2, I was owing 413,333, and I have settled 225,000, that means what I am owing now is 188,333. That is removing this 225,000 from my liability balance. So now, at the end of year 3, my liability balance is 188,333. That's the balance in my liability. Okay, good. So as a result of this exercise now, my liability has reduced from 413 to 188,333. So still in 2003, only a portion have exercised. So how many remain unexercised now? So let me do the math so I can get the valuation of that. So unexercised, there are, of course, 100 share option for those unexercised, the 500 employees, the people that actually left in year 1, 40 that left in year 2, 22 that actually left in year 3, minus the 150 that exercised in year 3. So whatever balance you have is 253. That's the remaining employee that have not exercised. If you do your math and multiply it by the fair value of that right at the end of year 3, which is this 18.2, that gives a valuation of 460,460. So again, as against what I have here as the balance of my liability, When I value those that have not exercised, I even saw that what I'm actually owing is 460, 460. That means my liability has increased by how much? So 460, 460 minus the balance in my liability account. Okay, so that goes to my P&L. This should be reverse. So whatever is the balance goes to my POL, right? So this is my new liability balance now. It sits in my liability. This is when I look at my liability account, I see that, okay, this is what I'm owing now. As far as this transaction is concerned, this is what I am owing. So this one goes to POL as my staff cost for that year. So that's for 2003. Now in 2004 now, they told us that another 140 exercised. Another 140 exercised again in 2004. So which is this? If you look at the question, 140 people exercised in 2004. So multiplying that by 100, multiplying that by the intrinsic value at 2004, looking at the question, this is 20. So 100 times 140 times 20, that shows that I will have to pay 280. So reduce my liability with that amount. Bank money is going out. So how much am I owing left? What is the balance of my liability? Don't forget, my liability value, the unexercised value is 460. Out of that 460, I am paying 280. So I remove 280. So I see that my liability balance is now 180,460. This is now my liability balance. Again, now that I know as a result of these people that have exercised, that have paid, I know how much I'm owing now. The balance in my liability is 180,000. Now that 140 has exercised, how many is now unexercised? Don't forget, it was 253 that was remaining in year 3. Out of that 253, 140 has exercised. 140 has exercised. Whatever balance, 240 minus 140, that should be like 113. Multiplied by 100, multiplied by the fair value of the rights at 2004, which is 21.4, which is this, 21.4. So if you do your maths, that means the value of my liability now is 241,820. How did I do this typo? I was putting my liability here. Two, four, one. So the value of my liability is 241,820, which is what I'll put in my liability account. 241,820. Then my expense now, my liability has increased from, it was 180 before, based when I paid some people. But now, looking at the valuation of the unexercised, is now 241. So my liability has increased by 61,360. That's an additional cost that goes to my staff costs. So 61,360. And my liability balance is this. And that's the end of year 4. Now, in year 5, exercised, they told me that the remaining 113 exercised. The remaining 113 exercised in 2005, which coincided with our calculation, the unexercised people. If you do 53 minus 140, that's that 113, which is the remaining people that have exercised. So They are going to exercise at the intrinsic value at that 2005, which is this 25. So 100 times 113 times 25. If you do your maths, it gives you 282,500. 282,500, which means that I'm actually going to pay this. So I debit my liability, credit my bank. So if I'm paying this, right? So my liability I thought was 241,820, but what I actually have to pay is 282,500 instead of this. So I'm paying even more. So there's an increase in liability of 40,860. My balance there is for 40,860, which I'm going to close to my P&L straight on. So I will just transfer it to my P&L so that because there will be nothing again. So if the balance here is it even a balance? Well, let me just call it balance because just like it will not be like a debit balance. What I have there before was 241,820. Now if I'm paying over because I have to pay 282,500. So this 4680 now is more of like an additional cost to me. It's more of like like an additional cost that goes to my profit or loss. And that ends this particular question for cash settled. So this is a very, very good question because this question has exposed us from the beginning to the end of all the dynamics you can have. It has shown you the normal thing. It has shown you how you book for exercising. So this is a good question that you should go and practice and understand very well. So for today, I will have to stop here.